It's probably going to be one or two more rate hikes. They're going to be small hikes like the one that we just saw. And then I think the Fed will pause. Where I think people will be most disappointed is that I do believe that we can take Powell at face value when he says that he'd like to keep policy restrictive for a bit longer. The Fed is going to be erring on the side of overshooting as opposed to easing too early and then allowing inflation to surge back. So just a couple more rate hikes at most, but then I think we'll see rates higher until the end of this year or early next year before the Fed starts to cut.
You don't think that that would then need a repricing when it does come to equity values? Because we're at around about 375 and there still does appear to be a little bit of a disconnect on the tolerable PE that you're able to achieve. So right now, if you're looking at the EPS just on a bottom up, it's 222 for FY23. Is there more pain to come? And then what does that mean for how you're viewing your investment strategy moving through into 2023-24?
Certainly with respect to U.S. equities and developed market equities, we're a bit bearish at this point because, as you say, risk is not really priced at the level that we'd expect at this point in the cycle, given everything that the Fed is saying. So the market is fighting the Fed. We think that the hit to earnings is going to continue, and so we'll see a bit more pressure on corporate earnings, and markets are gradually going to wake up to the fact that rates aren't going to just drop back down overnight, and so equity valuations seem a bit rich at this point.
Right. Going through your notes, you're talking about EM investing as well, Phillip, and I wonder how you're thinking about the whole Adani issue. Casting a dark cloud over EM assets, especially infrastructure companies that are indebted, highly indebted?
Well, I think Adani, this is really characteristic of the thing people fear about investing in emerging markets. You know, this is a company that was growing very quickly, and a lot of investors, they look at emerging markets and they think, you know, some of these names, the bigger, more familiar names within EM, that's how you access growth. It turns out that was really expensive growth. It was obviously low quality growth. And I think the key here is that you should look for growth at a reasonable price. You know, emerging markets certainly growing much faster than developed markets, but you still have to pay attention to fundamentals. If you looked at Adani, there was a lot of debt like you suggested. You know, this is a company that was making lots of expensive acquisitions to fuel that growth. And it turned out the company's operations weren't very efficient. And it's really empire building. You know, it's a textbook case of poor governance. And so when we look at emerging markets investments, we think investors are fearful. That creates lots of bargains, but you really have to focus on governance and on fundamentals and look for quality growth as opposed to, you know, some of these flashier names in the end.